Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Well, the dreaded mid and small cap correction is finally here. After closing at a record high of 57,703 on 11th December 2024, the BSE small cap index has tumbled to 45,157 in just over 2 months, a fall of almost 22%, thus putting it in the category of a bear market. Of course, this is just the index I'm talking about. Individual stocks have taken a much worse beating, some even falling by as much as 50%. Opinions on what the market will do next and what should be the next course of action is extremely divided as expected. There are some who are anticipating the markets to fall further, while there are others who believe that this could be a good time to start accumulating fundamentally strong small caps. The current correction takes me back to July 2018 when the BSE Small Cap Index had entered a bear market for the first time after crossing 20,000. The situation then was similar to the situation right now when the index has entered into a bear market after reaching a lifetime high. Now, suppose that someone wants to take advantage of the current fall in the small cap index and wants to put together a portfolio of 20 stocks for the next 3 years. Is it advisable to do so? Besides, what are the kind of stocks he should have in the portfolio? In all honesty, while history does not repeat itself in the stock market, it certainly rhymes. Hence, it will be a good idea to check out how a portfolio of 20 stocks would have done over the next 3 years in a similar bear market in the past. Now, I just alluded to the bear market of July 2018, where the BSE Small Cap Index had crashed more than 20% after crossing a lifetime high of 20,000. Let us use this bear market as a case study for whether it makes sense to invest in the small cap index after a fall of 20%. Here's what I did. I put together a portfolio of 20 small cap stocks back in July 2018 and tracked its performance over the next 3 years. The reason I took 3 years is because it is an ideal time period in my view, neither too short term nor too long term. It gives enough time for a bear market to end and for a new bull market to start. So, a fall of 20% from the top is a good time to start building a portfolio, in my view. What about the stocks though? What kind of stocks should be included in the portfolio? Well, here also I'd like to keep it very simple. I will include only those 20 small caps that are available at a PE ratio between 10x and 20x and have as little debt as possible. The idea is to include fundamentally strong companies that are available at attractive valuations. A PE range of between 10x and 20x is indeed attractive in my opinion, as it is neither too cheap nor too expensive. A PE below 10x may lead to a lot of value traps in case you are not careful, while a PE greater than 20 times makes the stock price too sensitive to the company's earnings growth rate. Hence, a PE ratio between 10x and 20x consists of stocks that are not too challenged fundamentally and where even a small improvement in earnings growth over historical trend can lead to a sharp jump in share price. It is these characteristics that led me to create our 20 stock portfolio with stocks between a PE of 10x and 20x. Now, if I'm allowed just one financial ratio to assess the fundamental strength of a stock, I would like it to be the vintage debt to equity ratio. A consistently debt free company is a company that's usually consistently profitable, has a product or a service that is regularly in demand by its customers, and has a management team that usually prioritizes stability and safety over high growth. And these are all the qualities that you need in your stock. Therefore, in addition to a PE ratio of between 10x and 20x, I also insist on a debt to equity ratio that's as close to zero as possible. I want each of the 20 stocks in the portfolio to be nearly debt free. So here's what we are doing. We are going back in time to July 2018 when the small cap index had suffered a more than 20% drop, and we are building a 3-year 20 stock portfolio of small caps with a P ratio between 10x and 20x and debt to equity of almost zero. This is what the 20 stock portfolio would have looked like. If you want, you can pause your video here and go through the name slowly once. Now, do you know the returns that this equal weighted portfolio has given over the 3-year period between July 2018 and July 2021? Well, it stands at an impressive 82%. Yes, that's correct. A simple portfolio of 20 small caps that are both fundamentally strong as well as attractively valued would have outperformed the 68% returns earned by the BSE Small Cap Index during the same period. Hence, an investment strategy of investing after a 20% fall in the BSE Small Cap Index has certainly worked out in this case. In fact, at almost 19% CAGR, even the BSE Small Cap Index has given good returns during this period. However, at 22% CAGR, our 20 stock portfolio has done better than the BSE Small Cap Index. Okay, what do you think about these 20 names now? Again, looks like a decent portfolio, isn't it? Again, you can pause the video and take a proper look at the stocks if you want. Now, this hypothetical portfolio was created back in June 22 when again the BSE Small Cap Index had taken a more than 20% tumble from its highs. That is the same situation that we are in today. Besides, the criteria were also the same, that is a P ratio between 10x and 20x and almost zero debt status. So how did this portfolio do between June 2022 and now, that is 17th of Feb 2025? Well, it almost doubled in value. Yes, that's correct. Buying after a 20% fall in the BSE Small Cap Index has again proved to be a rewarding strategy with the portfolio doubling in value. Now, worth highlighting that even the BSE Small Cap Index did quite well during this period and notched up gains of almost 86% point to point. Yet again, our simple 20 stock portfolio outperformed the BSE Small Cap Index. Now, based on these two events, it is clear that investing in fundamentally strong and attractively valued small caps after a more than 20% fall does have a chance of working out well over a 3-year period. And if this is evidence enough for you to start thinking of building your own 20 stock portfolio, here are the names you can have on your watch list. These are the stocks that you can keep on your watch list if you are looking to invest in small caps at the current levels. Now, the last 2 times the index fell 20% from the top, a portfolio with the same qualities or characteristics as these 20 stocks did really well over a 3-year period. Will history repeat itself? Will these stocks also give similar returns over the next 3 years? Truth be told, there are no guarantees in investing. All you can do is follow a sound process and then hope for the best. And if it is some consolation, our process is indeed sound. We are not investing at all time highs, but after a significant fall. Plus, we are also looking at building a portfolio of fundamentally sound companies trading at attractive valuations. So if the small cap index does well over the next 3 years, there is a strong chance this portfolio will also do well. If you still have some doubts, you can always consider partial buying right now and the remaining after some more correction, which may or may not happen. The choice is yours. Please note that there are no certainties in investing, only probabilities. And this is how you should always approach the market, with a probabilistic lens. That brings me to the end of this video. I'll see you again in the next session. Goodbye and happy investing.